Hello and welcome to my video series on property investment basics. In today's video, we're going to look at the 5 profit levers in property. Okay, so the first thing that we're going to leverage is our money, our pounds. So basically, when we leverage our pounds, we purchase with a mortgage as opposed to purchasing in cash, as this increases not only our purchasing power, but also increases our returns. As a result, with a £100,000 budget and a property purchase price of £100,000, we can buy not just one £100,000 property, as would have been the case with a cash purchase, but we can now buy 4 properties. We need a £25,000 deposit on each property, and then we can take out a mortgage for £75,000 for the balance on each of the 4 properties. Okay, so what's the second profit lever? So the next thing we leverage is the price that we buy at. In other words, we buy at a discount. So if we were to negotiate, say for ease of calculation, a 20% discount on our £100,000 property, then with a reduced purchase price of £80,000, we only need a £20,000 deposit per property. So in this case, when we buy at a discount, we can now buy 5 properties. And that gives us instant equity of £20,000 per property, which over our 5 properties already gives us £100,000 in equity. So the next profit lever is cash flow, and any investment property needs to be cash flow positive after payment of all expenses and costs. Now the level of your cash flow will depend on your strategy. At the lower end of the cash flow strategy, we've got the buy to let, which you should aim to make around £200 plus per month profit. That's £2,400 per year. So for 5 properties, that's a total in cash flow income of £12,000 a year. At the higher end of the cash flow spectrum is a serviced accommodation, which you would hope to achieve around £1,000 a month, £12,000 a year. So there again for the 5 properties, that's £60,000 income per year. Now looking over time, say the next 20 to 40 years, you can see just how that cash flow builds up. But cash flow, however, is only part of the story, and we need to take into account our 4th property lever, which is capital growth. Now, if you've educated yourself in the right areas in which to buy in order to benefit from capital growth, then as the market goes up, the value of your properties will also go up. Historically, house prices have risen on average by 7.9% each year. I stress the word on average, as property market moves in cycles, going through periods of booming prices, periods where it's relatively flat, and in some periods as well where obviously the market crashes. There's also, you'll find that property prices in some areas go up more than in other areas, but on average, property prices do rise by 7.9% per year, and that's happened over the last 90 years. Now, clearly, as with all forms of investment, we need to understand that past performance is not a guarantee of future performance. Okay, so had we not bought at a discount and we'd paid the full £100,000 price, when the market has gone up, say 10% for ease of reference and ease of calculation, each property would now be £110,000 in value. So that's £10,000 of equity growth per property. So we've got a total of £40,000 in equity growth. Because, however, we used a profit lever and we bought at discount and we only paid £80,000 per property, then when the market has gone up 10%, those properties were still worth £100,000. They're now worth £110,000. So we now have £10,000 of equity growth per property. So that's a £50,000 capital growth that we've got. But we also have the £100,000 instant equity from the discount because we saved £20,000 per property. So our total equity now, having bought with a mortgage and having bought with a discount, is £150,000. The 5th profit lever is the ability to refinance, but it's important to note that this lever is only possible if you have profit levers 3 and 4. In other words, you need to have both great cash flow and great capital growth. So when the market has gone up 10%, our properties are now worth £110,000. We can now go back to the bank and ask to refinance, raising a mortgage to 75% of that new value, which means a mortgage of £82,500 per property. Now, because the initial mortgage was only £60,000 per property, because we'd negotiated a discount on the purchase price, that means we can now pull out £22,500 per property. So that's a total of £112,500 in equity release. So we've been able to pull out our full initial investment just from that initial 10% increase in market value. This is the power of property, people. It's amazing. You can't buy shares at discount. You can't walk into a bank and say, I'd like to buy £100,000 worth of shares. I'll pay £25,000. Will you pay the rest, the other £75,000? It just doesn't happen. So this is the magic of property investing. The equity release, that £112,500, can now be either put into your savings account, or it can be used to do it all over again and buy even more properties. Happy investing.